Hi everyone, welcome back to our channel and welcome back to another episode of Capital Insight series. This series sits within our Fundamentals Through the Noise series here at Punjab Capital Research. And today we wanted to talk to you about how the IPO lockup has quietly stopped protecting the public buyer. It's about what happens when the gatekeeper is being paid by the seller. Essentially, what we are talking about is that the lockup is meant to shield new public shareholders in the fragile early months of a listing. But it was never a law, only a private handshake enforced by the same banks that get paid when it's broken. And today we're going to share with you a plain language look at the quietly failing guardrail and a read from the buyer's side of the trade. Today, let's focus on the guardrail that most investors assume protects them, but it turns out that it's optional, temporary, and it's administered by a party with a reason to remove it. Here's what it means when you are the one who's buying the stock. First and foremost, let's look at the promise in plain terms. When a company goes public, the people who already own it, that's the founders, the executives, and above all, the private equity firm that controls it, usually agree not to sell their shares for the set window. Most often, the window is around 180 days, and the agreement is called the lockup, and its purpose is simple. In the first few months of trading, the market does not yet know what a new stock is really worth. If the biggest and the best informed owners were free to sell on day one, they could flood the market and knock the price down before public ever got a fair deal on the stock price. The lockup holds them back long enough for an honest price to form. And here's the part that almost no one on the outside of the deal thinks about. The lockup is not a law. Nothing in the rulebook requires it. It's a private handshake between the company, its early owners, and the banks that are running the IPO. And like any other handshake, the people who made it can undo it also. Next, let's look at it who holds the keys. Now, the banks running the IPO, that is the underwriters, control the release. If an early owner wants to sell before the 180 days are up, it asks the lead bank for permission and the bank can say yes or no. Now, let's look at the incentive out here. If a private equity sponsor sells early, it does so through a new stock sale and the sale pays the bank a fee. The bank most likely to run it is the very same bank that ran the IPO also, and it holds the lockup key. So the bank that is supposed to guard the gates on behalf of the public buyer earns money by opening it for the seller. Now that is the quiet flaw at the center of the whole arrangement. The referee is being paid by one of the teams. Next, let's do a deep dive into what it looks like in practice. Let's start with the extreme case first, Fulgent. Now this electrical equipment maker owned by PE firm Neos Partners went public in early 2026 and then sold more stock 3 separate times inside the 6-month window. Now, it used the money raised from the public to buy out its own private equity owner, while that owner sold its remaining stock alongside. Neos went from roughly 81% of the voting power just after the IPO to under 50% in about 5 months. Now, read plainly, the public market did not fund the business here. It funded the owner's exit and was handed the shares in return. Next, let's look at the repeat case, Legence. Now, this Blackstone-owned engineering company listed in September of 2025. Blackstone then sold a block of stock in December, about 3 months in, well inside the lockup, and then came back for a second sale of roughly $831 million in the following spring. The same 2 banks led the IPO and the follow-on sale, and each time that Blackstone sold, the stock fell around 7%, even though company raised no new money and kept posting strong results. The market, in other words, is quietly marking down the insider exits as a vote of low confidence. Finally, let's do the pre-wired case, Solve Energy. Now, this one is the most chilling. Solve, owned by American Securities and listed in early 2026, the sponsor sold a stock a few months later, but the escape route was not negotiated after the fact. It was written into the company's own legal structure from the very beginning, which allowed its sponsor to cash out its own stake through exactly this kind of follow-on sale. The fast exit was not an exception to the plan, it was the plan altogether. And this brings us to the most important part of the discussion. Why the rush and why now? The reason is not complicated. Private equity firms have promised their investors, pension funds, endowments, family offices that they will hand back cash. And for the last couple of years, that cash has been stuck. Sales and public listings slowed down, and Beskedin's 2026 estimates somewhere between 4 and 6,000 US private equity exits were pushed back. And at the same time, the appetite for liquidity is enormous. The market when investors trade out of private stakes hit a record of about $160 billion in 2024. And so the pressure to return money is higher than it has ever been in years. And the moment a new public stock trades well, the sponsor takes the opening the lockup used to make it wait for, and increasingly it does not wait. Let's talk about the cash the buyer should notice. Firstly, the escape hatch only opens in good weather. An early release is usually permitted only when the stock is trading comfortably above the IPO price. That sounds reassuring until you see what it means. The selling is designed to happen when everyone is optimistic and to vanish when they are not. The valve that lets the sponsors out opens precisely when the extra supply is least expected and the buyer is least on guard. And it does nothing in the downturn when liquidity actually matters most. It is a fair weather mechanism dressed up as protection. Secondly, the exit itself is information. A sponsor trimming a stake slowly over years is ordinary. A sponsor heading for the door within months, especially one that built the escape route before the doors even opened, is telling you how it really feels about holding the stock. You do not have to guess at this. It is all there in public filings: who is selling, how much, how fast, and through which bank. And finally, let's wrap up with a word for the allocators out here. Now, the lockup was never the ardence and protection that it looked like. It was a courtesy enforced by a party with a standing reason to withdraw it. That does not make every fast exit a scandal. Sometimes a sponsor genuinely has good reason to return cash quickly. And a strong shock can absorb the selling. But it does shift the burden onto the buyer to look rather than assume. And therefore, for buyers, before buying into a recently listed private equity-owned company, read the exit: who is selling, how fast, through which bank, and whether the cash out was wired into the structure from the start. Now, in today's market, it's important for the buyer to treat the lockup as a signal to check and not as a promise to trust. Now, that's all I wanted to share with you in this brief update video. Stay tuned in for the next one.